So we are on the interest component. We are done with that. Then we are at the service cost component. The employees work. Since they work, that's what makes them entitled to receive the what? Benefits, right?
Yes.
And so we need to know the cost, the service cost what? Component. The service cost component is charged to profit or loss as usual, just like the net interest component. It also goes as a statement of profit or what? Or loss. And it has the current service cost and the past service what? Cost. But also we have any gain or loss and settlement. Okay, we'll see one by one. When we speak of the current service cost, what is it? It is simple. We consider the current year. That's why you call it the current service what? Cost. So it is the increase in the present value of the obligation. Look, like I told you, you have the plan assets and the plan what? Liabilities, right?
Liability. And
And remember, I told you, when you read something, you need to know whether it increases the plan asset or the plan liability to be able to define it well, right? If the cost, it would increase
Okay.
what? The liability, which is the obligation. So that's why we are told it is the increase in the present. When you say it is the cost, means it increases the liability. That's why you say it is the increase in the present value of the obligation arising from employees' service in the current what? Period. So
Period.
when we're given the figure in words in an exam, you should be able to spot that, right? Whenever you see, okay, the present
Yeah.
obligation has increased due to the current year service of the employees, okay, that's my current service what? Current service cost. But then we have the past service cost. What is it now? It's past, but why are you including it? We say this is the change in the present value of the obligation for employee service in the prior what? Periods, resulting from a plan amendment or curtailment. You can see this, right? Maybe previously there was a certain plan, but now the plan has been amended. There has been a change, right? In case
Yeah.
there has been a change, we said that okay, previously we had this figure, but we have had a change. If we had a change, we try to account for it even to accommodate it even the previous years, right? Presume maybe
Yes.
previous years, 4 years have passed, and the liability was 100,000. But we say that we have amended the plan, and we say, okay, in case since we have amended the plan, in case this plan was in action since 4 years ago, the obligation wouldn't have been 10,000, maybe it would have been 12,000. You see, there is a change
Okay.
of 1,000. 2,000 has increased, it has come up just due to that. And so we call that a past service cost. So it just doesn't change all of a sudden, right? There is a reason for it.
Yeah.
When you are reading the exam, right, you should see something like this. Maybe the
Yeah.
plan was amended and maybe the cost was this. So you say, okay, this is the past service what? Cost. Or probably you have been told it could either be a curtailment, right?
Yes.
Maybe it's a curtailment, right? You know what the curtailment is? Let's read the curtailment here. It's here, right? When you curtail, it is like you reduce something, but it's like you reduce the scope of something to a certain extent, right?
Okay.
That's why I say the curtailment is a significant reduction in the number of employees covered by a pension plan. Maybe it was just a decision to say, okay, we are covering 20 employees, but maybe, okay, right now we'll be covering like what? Let's say like 15 employees from 20. You see that?
Yes.
So that's why I say this reduction may be a consequence of employees being what? Made redundant. Let's say you had 20 employees, and right now you only have how many? 15. You can see
Okay.
this is okay. Probably we would have paid much more here than what? Than here, right? So you see
Yeah.
that? Yes. So by that, you
Yeah.
have to account for that thing. Because right now, previously we had 20, but now we won't account for 20. We would account only for how much? For 15. But remember, when computing the plan liability, we usually take the present value of future payments. So it's like initially we had considered that all of the 20 employees, but as the years go by, you see that, okay, and right now they're only 15, right? We only have 15. Since we only have 15, we have to make some changes, right?
Yes.
Yes, so that could also be the what? The reason. And now, and the last thing here is any gain or loss on what?
Settlement.
Settlement. You know, you may agree. Let's say you've agreed with the employees. Okay, okay, employees, we want to maybe you are leaving the company, for example, right? Or it could be anything. Maybe you know there is sometimes presume you had an employee and an employee is shifting to another employer, right? In
Yes.
the employee is shifting to another employer, then you could say, okay, so from this moment onwards, we are removing you from our plan, but you should be on the plan of your employer, for example, right? And so
Yes.
one company could enter into an agreement with another company to shift the obligation, right? Now, presume maybe
Yes.
an employee is working at entity one and the employee is going to entity what? Entity two. So the management of entity one and entity two will come together and they would speak. Entity one would say, okay, in my books so far, I have 200 million, right? Related
Yes.
to the obligation of these employees. Now, let's agree to each other. I'm shifting this 200 on your side, and you are the one who would have to settle, but I'm paying you something, right? So, presume
Okay.
entity one is transferring to entity two, but actually entity one is paying only 150. You see that?
Yes.
So, by doing this, it would be like the entity one has made a gain on settlement, right? Because it has transferred a huge liability. It has removed a huge liability by paying only how much? Only 150.
150.
It gives a net of how much? Of 50, right? Yes.
Yes.
So this standard just is just like the reality of what happens in the offices, right?
Okay.
Yes. So I think that's the example, and we can go down now on the past service cost. Okay, maybe just knowing more about the past service what? Past service cost, but we have seen it already. Past service costs are recognized at the area of what? Maybe when the plan amendment or curtailment occurs, like we have seen there above on the amendment and the curtailment, or
Yes.
when the entity recognizes the related restructuring cost or termination what? Or termination benefits.
Benefit.
Yes. Of course, this is obvious. This is the common one, and it is the basis of the definition of the past service cost. That should be due to plan amendment or curtailment, right?
Yes.
Curtailment, curtailment means like I thought the employees have been what? Have been laid, right? Off work.
Yes.
So it could either be recognized at the area of or what or the scope. Of course, whenever it happens.
Sir, you gone.
Okay, so this is what we mean. It's either when the plan amendment or curtailment occurs, or when the entity recognizes related restructuring costs or termination what? Benefits. Of course, in case maybe there have been a termination, the employees would also still not be there with the company, right? So it would be the same.
Yes.
Yes. And settlement, we have spoken about this already, right? Yes, I think we are speaking
Yes.
already. We said this when the entity enters into transaction to eliminate the obligation. We spoke of that 200, right? For part or all of the benefits under what? And
Yes.
we said that it is eliminating 200 and it is paying 150, right?
Yes.
Okay, and then the gain also on settlement is the difference. We are talking about the gain also on settlement. Is the difference in the fair value of the plan assets paid out and the reduction in the present value of the defined benefit obligation. That's what we said. You reduce the obligation by 200.
Yes.
It's like we have reduced by 200 and we have paid 150. Of course, that 150 should be paid from plan assets. You have the assets to use to settle the what? The obligations, right?
Yes.
So let's going on here. We have the contributions into the plan. This is not much, of course. Contribution is just what the employer would provide to the pension plan. And usually we have them in the form of cash. And that's why even when we prepare the statement of cash flow, you should be having contributions into the plan. Contributions are the cash payments paid by the employer into the plan during the reporting period, right? They cause no impact on the
Yes.
statement of profit or loss. Like I told you, they are the cash payments. They just the cash is cash. Isn't like they emanate from a certain transaction, right? So they directly affect the statement of
Yes.
cash. That's why I told that they have no impact on the statement of profit or what? Or loss.
All those.
It's like when you come up there, you should know that, right? See the opening balance, so it's no big deal in your current year's statements. Net interest component goes to statement of profit or loss, right?
Yes.
Statement of profit or what? Or loss. If we suppose
Um,
if it's is good is the net assets were high, of course it will be an income. If the obligation was higher, then this would be an expense. Service cost component is also an expense, right? To the income
yes.
statement. Contributions, it goes to the statement of cash flows. Statement of cash what? Flows. You have to get this right.
Okay.
Benefit paid won't affect here. They will reduce both plan assets and the plan liability because they would be paid out of plan assets and they would be used to settle the plan liabilities. That's why we have the dash there, right?
Okay.
So in the
Yes.
transaction, you wouldn't see them anywhere, but actually they would have worked. In case we had to show the plan assets and plan liabilities separately, maybe it is the time that they would have popped up. Okay, so let's,
Okay.
and at last, remeasurement component, this usually goes to the statement of comprehensive income. Statement of comprehensive what? Income. You have to,
Okay.
yes. It doesn't go to statement of profit or loss. It goes to other comprehensive income, just like the remeasurement, the revaluation gain under I-16 PPE. Right.
Yes.
And at the end, this net figure, of course, this is the asset or liability, so it should go to the statement of financial position.
Okay.
So you should know where each line item there goes, not a statement.
Okay.
Oh, yes. So we had this. You have seen the contributions too. After that, I think there is nothing much. Benefits paid, yeah, we have spoken about this. They are paid out of the plan assets to retired employees during the period. So this payment reduce both the plan obligation and plan what? Plan assets. So they have no,
Yes.
but we have seen that. And then you have the remaining
Yes.
component, like you have seen how we get them, right?
Yes.
Yes. So after accounting for the above, you would be having those figures. We would take the difference, like we just saw there, and I think everything go fine. And we are told they go to other comprehensive what? Income. Charge or credit.
Okay.
Or when you are told something is charged, it means it is like an expense. When it is credited there, it means it is like an income, right? If we say remeasurement gain,
Yeah.
of course, we say it is credited. If remeasurement loss, we say it is charged, right?
Yes.
But this we are told they go to other comprehensive income for the year and identified as an item that will not be reclassified to profit or loss. You know, there are items that you will come and see, maybe sometimes there are items that could be reclassified in the future period to profit or loss from other comprehensive income. But this when they go, and if you have ever seen some statements, when you have other comprehensive income, they separate their gain into two. Say item that could be reclassified later to either to profit or loss, and item that will not be reclassified. They like to say that, but this is not important here, right? Okay, so it's just like that. Yeah, they're just trying to bring up the concept of framework, and the remeasurement. But like
Okay.
you say, this doesn't matter here, especially for your case of diploma in what in IFRS, right? The concept of framework and the remeasurement. We say that
Yeah.
developing, the standards override the conceptual what? Framework. Conceptual framework is just the basis on which the standards are what? Are prepared. When developing or amending the IFRS, the board notes that, by the board we mean the International Accounting Standards Board, notes that certain
Okay.
expenses should be presented in other comprehensive income if results from the measure if it results from remeasuring an item to current value, or if it was statement means that profit or loss provide this. Okay, simply speaking, it doesn't matter on our side, right? As long as the standard says this, then that should be done, right?
Okay.
Yes, so summary of the amount recognized. This is just a summary, no problem. Let's take a look at this. We are told illustration 1, defined benefit plan. You can see the defined benefit plan is the major thing here. Defined contribution is actually nothing. So let's read this. The following information is provided in relation to a defined benefit plan operated by Celine. At 1st January 2024, the present value of the obligation was 140, and the fair value of the plan asset was how much? 80. You can see it? Yes. So you can have, you have the plan asset, net plan asset or net plan liability. You have asset or net plan asset or net, look, yeah, look.
Net plan liability.
Okay,
The liability is higher than the asset.
yes, so it's here, either deficit or net, you can call them whatever name you wish. They like to call it net deficit or net asset. You can also say net plan asset, net plan liability, whatever, right?
Okay.
Okay, so here we are. So it's a net plan what? Liability, great. Or net deficit,
Liability.
yes. And then we have here discount rate at the start of the year, 4%, 20x4 and 20x5, we have that. The current and past service cost, we have them. The benefits paid, contributions into the plan, the present values of obligation, and the fair value of the asset at the end of the year. I mean, the net plan obligation, net plan, you can see how net plan obligation, you can see net plan liability on a net plan asset, right? Net plan obligation
Yes.
or asset at the 1st December 20x4 and 20x5, and the amounts to be taken to profit or loss and the other comprehensive income for both the financial years. Okay, maybe we do this. This is illustration, what? Illustration 1, right? We can,
Yes.
yeah, let's say illustration 1. Okay, this is the first example here. Let's do it. So we have the 2 years. We have the 2 years in front of us. We have the 20x4, and then we have the 20x5, just like that. So at the beginning, we know what to do.
You are not.
I don't know why this happens. Hello?
Yes, now you are back.
No, I have to make follow-up on this. I don't know why it happens. We just speak and then it just gets slow itself.
Yes, it just goes.
Yes. It's like, it's like, let me not speak much. It just feels like something is damping, it's damping, eh? Just starts with a high amplitude, then it goes down, go down. Now I need to know the source of that damping. Okay, so
Yes.
we start with the net plan obligation or net plan liability for what? For asset. For asset, they like to use the negative. So let us do that to simplify matters. Net plan liability for asset. This is the opening balance. We can say BD, balance brought down, right?
Yes.
Let's get it now. For 20x4, we are told the liability obligation was 140 and the asset was how much? 80, right?
Okay. Yes.
Obligation 140. And now, like you can see, we have said that the obligation should be positive, right? If the obligation is more, we call it positive. So since that is the case, you should be saying the obligation minus the asset. So it's like 140 minus how much? Minus 80. Take the obligation, deduct the what?
The asset.
Means this asset is that it means the asset has a negative sign, like what they want, right?
Okay.
After that, we like I told you, you get the net interest component. Net what? Net interest.
Interest.
And the net interest should go to the statement of profit or what? Or loss. Yes, a statement of profit or loss. Okay, how do we get the net interest? You take the rate at the beginning of the year. What was it? How much was that rate? It's a discount rate at the start of the what? Or the year 20.
4%.
So just say 4% times this balance here, and you'd get 2.4, right?
Yes.
After that, we would have the costs and the benefits. Of course, here we already have current and the past service cost. I could just say service cost equal to 30. Service cost. This is 30. Service cost increases liability. So you just put there 30 positive, right?
Positive. Yes.
And then the benefits paid is 20. What do we do with the benefits paid?
Negative. It's reducing the liability.
Eh?
It's negative. It's reducing the liability.
It just reduces the assets. From where
Yes.
the assets.
Both.
So if
Yes.
it's both, it's zero there. Right.
Okay.
You see that?
Yes.
It's like in case maybe you were preparing and you see one column for plan assets, one column for plan liability, it would have reduced both. And so, but you see, it would have reduced both. But we are not looking for the figure for plan assets and plan what? Liabilities. We just need
Liability.
the net, yes. That's whenever how the benefits paid, put there zero because both are reduced. Okay?
Okay.
What next?
Yes.
Contributions into the plan. How much was contributed? 25. Contribution, these are like investments, yeah? Contribution.
Yes.
25. So it's an asset, so we say negative how much? 25. Because I said the asset should be negative. And then we are done, right?
Yes.
So since we are done, we could get our figure here. How much do we get? Let's sum our figures from 60 to 25 negative. We get 67.4. Yes, and after that, we now have our remeasurement. Remeasurement should be a remeasurement gain or loss. Remeasurement loss or what? Or gain. Or gain, yes. And now we have now our net plan liability or asset. You take it down here, net plan liability or asset. But this is the balance carried down, not balance brought down. This is the closing balance.
Okay.
Yes. How do we get that now? We do the same. We are given the value of obligation at the present value at the end and the value of the plan asset. So as usual, we say obligation minus what? Asset. 200
Asset.
minus how much? 120. So 200 minus 120 and we have 80. You can see that. So ask yourself,
Yes.
this balance here is still positive, right?
Yes.
It being positive, it means it is still an obligation. But also, this is also positive. So the obligation has increased, right?
Okay.
An increase in obligation only means this is a revaluation loss. Revaluation what? Loss. I would take the final figure minus the previous figure and see that, okay, it is also positive. So it's a revaluation loss. So you could do the same as the initial, right? When it's a loss, it's also sorry. We said the liability is positive. So when it's a loss, it's still also positive. Then the gain should be negative. Like I've told you, we go the reverse way because the expenses are much more, right? So that's why I
Yes.
decided to put them with positive. So you can say this is the revaluation what? Loss.
Loss.
Okay, this plan liability at the end should be the figure at the beginning of 20x5, right?
That's a balance brought forward.
Yes, for
Okay.
20x5. And then for 20x5, we would still get the net interest component again at 3%. Yes, so we'll say 3% times 80, and they would have 22.4. Then let's go for the service cost. Service cost is 32. So service cost increases the liability. Benefits paid, of course, even if it's there, I would have to put negative, right?
Yes.
0. And then contributions into the plan, it's 30. So contribution is 30, should be negative to negative 8. And then we can get our sum, which is 84.4. Okay, we skip this as usual, and we go down to get the what? The difference between the plan asset and plan liability. So plan liability is 140, plan asset is 230. So 140 minus 230, right?
Yes.
140 minus 230, we have that. Okay, let's ask ourselves. This is still positive, it's a liability, right?
Yes.
So here it's negative, it means it's a net plan asset.
Yes.
But as usual, you take the last figure, which is here, right?
Yes.
The top one. And what would you get? 174. We got 174.
Not correct.
Ah, no, I deducted. Sorry, this was 230 minus 140. The obligation is 230 minus 140. It's here.
Yes.
Yes, the obligation is
Yes.
230 minus the asset 140. The asset minus the obligation. I told you since the obligation is positive, we have to say obligation minus asset. The asset is negative, so that's why the asset is deducted. Right.
Sir, you are low.
Hello? Hello?
Yes, now I can hear you.
Okay, so like we say, this we done, yeah? You take the liabilities and then you deduct the asset because the liabilities are positive, and the assets
Okay.
are, if the assets are negative, they should have a negative sign on their left. So you can see it's like we had a liability, but it has just increased, right?
Again, you've gone.
Again,
Now you
again. Okay.
now you're okay.
Now, what about now?
Now you're much better.
Okay, so we can see that it has also increased. So both of the parts we have the revaluation loss, right? And so, like
Yes.
I said, this goes to statement of profit or loss. The service cost also goes to statement of profit or
Profit or
loss.
loss.
Is an expense, benefits paid nowhere. Contributions goes to the statement of cash what? Flows, right?
Well,
Remeasurement again
yes.
goes to other
Income.
comprehensive income. And net plan assets or liability, this goes to the statement of finance.
Statement of finance position.
See how simple it is. Maybe the thing that you should be aware of is, we usually presume the contributions are made further into the year, right? But
Okay.
it comes and it tells you that the contributions are made in advance. Just after the year start, the contributions are made. It means that, remember, the contributions increase the what? The planning asset. So they would affect this figure of 60. You see that?
Yes, sir.
In the case of immediate payment of what? Of contribution. For example, in case the contribution was paid immediately, this is what we would have done for 24, right? I would have said this, I would have done this, and then we'll say, okay, instead of getting the interest component, no, you get the contribution first. So it means contribution. The main aim of computing the net interest on the plan liability means we deal with the opening balance. Now, presume it is the opening balance and something is paid immediately, right?
Yes.
If something is paid immediately, it means it affects that opening balance. You have to restate the opening what? Balance. In that case, I would have said contribution was how much? 25 negative, right?
Yes.
So I would have said in negative 25, just like that. And then I would have had the restated what? Restated
Balance.
And this restated balance would have been now the summation of these two, right? You see, it would have been 35. And by 35 now, I would have to proceed with my net interest all the way, of course, down here, right? So I would have said, okay, I'll just come and paste everything there. But now, this interest, it was 4%, yeah? So I would have said my interest is 4% times, instead of multiplying by 60, I would have multiplied by 35. You see that now?
Okay.
Yeah, so that's something you should be
I think
aware of.
the above one is bit direct.
Yes. And so you have to be careful when you are told the condition is paid immediately, you have to come and affect this. So you'd have this. Whenever you come here, we started from the restated balance, which is fine. We added everything very well. Then we came here, you see, we would have seen something like this. We would have seen the 80 here. It would have had a loss of 88, right?
Okay.
Okay, so you have to be careful about this. I hope that I added everything well. 36, 36, 41, yes. So it's just like that.
Okay.
Okay, let's go back. We have already seen what goes to profit or loss, right?
Yes.
What goes to profit or loss? Service component and then net interest component, other comprehensive income. We have seen this 12.6 and 5.6. These ones.
Okay.
And then the remeasurement again, yes, we have seen them all. The reconciliation of net obligation. Okay, I think everything is fine. Yeah, that's all. Okay, let's go now. We have maybe just another illustration here. And what were we told? We are told an entity operates a pension plan that provides a pension of 2% of final salary for each year of service. Okay, this is fine. On 1st January 2025, the entity improved the pension to 2.5. You see, we said past service costs will be either due to plan amendment or curtailment, right? Some people have left.
Yes.
All the plan has been amended. On 1st January, entity improved the pension to 2.5%.
Where you gone?
Okay. Improves to 2.5% of final salary for each of the year of service, including the service before this date, which is the past service now, right?
Yes.
Employees must have worked for the entity for at least 5 years in order to obtain this increased what? Benefit.
Okay.
At that date of the improvement, at the date of the improvement, the present value of the additional benefits for service from 1st January 2021 to 1st January 2025 is as follows, right?
Yes.
Now we have our figures from 1st January 2021. We are told for 5 years. And look here, we have from 1st January 2025 to 1st January 20, sorry, from 1st January 2021 to 1st January 2025 are like as follows. Employees with more than 5 years service at this date, the additional benefits have increased by 150, right? And for
Yes.
employees with less than 5 years of service at this date, which is our date actually, with the average length of 2 years, it's 120. And the total figure gives us how much? 270. That's what we have been given. And then you have to explain how the additional benefits are accounted for in the financial statement for the what? Of the entity. Okay? So this is how we're going to do this past service cost. So I would say the entity would recognize 70 immediately as an increase in the defined benefit what? Obligation following the amendment to the plan on 1st January 20x5. I would leave this question you never ask me why we have done this. This increase will form part of the service cost component. Of course, forming part of the service cost component is obvious because it is a past service cost, right? And whether or not the benefits have vested by reporting date, to the PowerPoint, whether or not the benefits have vested by the reporting date is not relevant to the recognition as an expense in the financial statement. You see that? And this was the main aim
Yeah.
thing. Because you can see that they had some had not vested. We are told here that employees must have worked. This is the condition. Must have worked for the entity for at least 5 years in order to obtain the increased benefit. Right.
Yes.
In order to be paid those benefits. Benefits are paid out of the assets and they settle the liabilities, right?
Yes.
Recognizing the service cost doesn't have anything to do with the benefits. It would just increase the obligation, like we said, right?
Yes.
Keep increasing the obligation, that is fine, right? Yes. But actually, when you want to pay, you won't have to pay such benefits. And that's why you can see here, we have employees should have been for at least 5 years, but we have employees with more than 5 years, 150. Employees with less than 5 years, 120. So you
Mhm.
why are we including 120 while it has not vested, right? It has not matured.
Yes.
Why? So you do include that because here we are speaking of the benefit, right?
Okay.
Yes. Okay, so we have, what else do we have? Let's go on curtailment here. We are told AB decides to close a business segment, and the segment's employees will be made redundant and they will earn no further pension plans. This is curtailment now, right? Above was the plan amendment, but now it's what? Curtailment, after being made redundant. Their plan assets will remain in the scheme so that the employees will be paid a pension when they reach the retirement age. It's fine. And this is a curtailment without settlement. It's like that. Yeah, here we are curtailing, but you're not settling. The employees wait until their what? Their
Yeah,
retirement. Yes. Before the curtailment, the scheme assets had a fair value of $500,000 and the defined benefit obligation had a present value of how much? Of before curtailment.
fund.
And it is estimated that the curtailment will reduce the present value of the future obligation by what? By 10%,
10%.
which reflect the fact that employees will not benefit from future salary increases and therefore will be entitled to a smaller pension than previously estimated. Of course, because like I told you, that obligation is based on the future, what you would get on the future, right?
Yes.
Now you have been curtailed, so you want to receive what was original. So required, we are told what is the net gain or loss on curtailment, and how will this be treated in the financial what? In the financial statements. Well, whenever you have the gain loss on curtailment, it is just taken to profit or loss. So, like you have been told, the obligation is to be reduced by 10. How much? Ah, wait. This is